Some people may speculate that the fall of SVB was caused by nefarious actions or that it is part of a larger, sinister plan. Some of the theories that may be circulating about the SVB crisis could include claims of sabotage or intentional manipulation of the market, accusations of collusion between powerful actors in the financial sector, or theories that the crisis was manufactured to achieve certain political or economic goals. But really, the fall of Silicon Valley Bank, SVB, has caused a strong shake-up in the banking and venture capital industries, especially focused in recent years on technology startups. The bank has experienced the largest bankruptcy since the collapse of Lehman Brothers, but will be able to open from this Monday exclusively for those customers who have deposits. The bank insurance only covers the first $250,000, with the rest at risk of being lost. The serious situation has forced the California Office of Financial Protection and Innovation to intervene in order to avoid contagion effects on the system as much as possible. To this end, the Federal Deposit Insurance Corporation, FDIC, has been appointed as administrator, and all savings have been transferred to the National Bank of Santa Clara Deposit Insurance, created solely for this purpose. SVB is a bank unknown to the common bank user in Europe, but in the US and especially in the area where it operates, it was an institution. Most startups operated with this banking firm. The first to feel the ripple effects of this bankruptcy are the shareholders, who have seen their investments lose 60% since last Thursday. From highs in 2021 and in the midst of the technology bubble, the collapse reaches 84%, to $106 per share. The main problem of this institution is its strong exposure to U.S. public debt, theoretically the safest in the world. However, with the rise in interest rates in the last 10 months, these fixed income values have plummeted in the markets. According to Bloomberg's calculations, exposure to public debt would reach $620 billion. It should be remembered that Lehman Brothers revealed $500 billion in subprime assets. Has public debt become the new toxic assets? How exposed are banks? What latent or on-paper losses does the banking system have? These are the questions that analysts and investment funds are trying to resolve as they conduct their analyses throughout the weekend. Another question is whether banks have revealed their losses from debt, as the European Central Bank has done, which has had to rely on provisions to achieve balance and suspend dividends, with the Bank of Spain as one of those affected. On the other hand, all attention is focused on venture capital. Banks and investment funds have invested billions in startups and companies that theoretically promised strong growth. However, the vast majority of them have literally burned through money, taken on debt, and without having a secured business plan. Silicon Valley Bank is not only the bank for startups, but all of its business lines focus on this technological world. That is, these small firms looking to become unicorns, a $1 billion valuation, as soon as possible will no longer have SVB's money, and the already established ones will now face tough market restrictions. Among its clients are Roblox, with a 70% drop from its highs, and Roku, with an 86% drop in just 2 years. Silicon Valley Bank offered funding for all types of startups, especially in entertainment and the health sector through technological solutions. Unlike other firms, SVB granted loans almost without control, while other banking-related entities demanded viability plans and payments, as well as successful seed phases, from their clients. According to its own data, SVB supported 44% of technology and health IPOs in 2022, and 55% in 2021. That is, it was present in 1 out of every 2 IPOs in recent years of these types of companies. Have they become a bubble? Looking at the collapses of new technologies, there is hardly any difference from the bursting of the technology bubble in 2001. The short sellers, on their part, are taking advantage of this bankruptcy by venturing into high-volume venture capital funds such as Brex, Ramp, and Cathie Wood's investment vehicle ARK. According to the latest available data, as of the end of 2022, the fund's largest exposure is focused on Zoom, 9.6%, Exact Sciences, 8.6%, Tesla, 7%, Roku, 6.2%, and Block, 6.2%, among other companies. Wood's fund has plummeted 73% from its 2021 highs, and short sellers have practically bet on its bankruptcy by increasing their positions in recent days following the SVB bankruptcy. On the other hand, listed banks in Europe and the US believe that panic has not yet been unleashed in the market following the SVB bankruptcy. However, analysts consulted by this medium not only see risk but also a contagion effect in case clients begin to withdraw deposits from their institution.